There are three basic accounting terms you must know, and why I do this here. So when I have debt, okay, which is over here, liability. The reason I want a lot of debt is because my hamburger business is paying for my debt. What is that called?
It's called amortization. So you're paying down the debt with other money.
So let's say I have $20 million in debt here. Every hamburger is being sold is paying down my debt. Is that tax-free?
That is.
It's amortization. But if you're on this side and you have a house, is amortization tax? Well, not really, but who pays for that amortization?
Well, you pay for it.
Yeah, these guys here are the suckers in this whole deal. I have a big house. That's why most sports stars are bankrupt, because they get the $20 million contract and they buy a big house for mommy and daddy, right?
That's right.
But they don't get this break here. The other word that is important is this word here, and that's called appreciation. So what does that mean to you, Tom?
Oh, what that means is this is the asset column. It means that as the real estate goes up in value, it's appreciating and you get the benefit. What I love here is where the debt goes, it's the bank's money. That's the bank's money. But you get the appreciation on your money and the bank's money. And that's what's magic to me.
Yeah, so let's say I have $1 million of my money in here. By levering up, I got $6 million. Now this thing goes up in multiples of 6. Does the bank take any of that money?
They get none of it.
Debtors are winners, you know. And then we have the third word. So you got amortization, appreciation, and this is the magic word here that most people don't understand. It's depreciation, and this is where it gets tricky. Why is that? Why is it actually both sides?
Well, because what happens is depreciation is a deduction for tax purposes, but it's no money out of your pocket. So because of that, what's really happening is you're lowering your taxes. You're lowering your taxes with the depreciation, okay, because you pay on net income, right? So you lower your taxes with depreciation, which increases the amount of cash flow.
Yeah, so let me say this much. So let's say I have $100,000 in here that goes to taxes, but because I have depreciation, I don't have to pay the $100,000 in taxes. So that means my income goes up, but it also means my expenses went down. This is number one of all the things that's hard to understand. This is simple. Everybody knows appreciation. Mm-hmm. Everybody knows amortization. I paid my car off, I paid my student loan off. But this here is the trick here. You see, depreciation means you don't, instead of paying $100,000 in taxes to the government, I keep the income. That's why it goes up.
Let's say that outside of this, let's say you didn't have this, and you have all this income from your business, right? Or from this business, either one. Let's say that you have all this income coming in, you're paying all this tax. Let's say you have $100,000 of tax, okay? Now you go out and buy a piece of real estate. Well, why does the government give you an incentive? Well, because they...
Not a house now. Not your residence.
Not your personal residence. This is investment. So this is housing for other people.
Apartment houses.
Or this is commercial property for a business. Any kind of business real estate.
That's bought with debt too. Now
we add the debt. So now let's say that we had $1 million of your own money and $5 million of the bank's money. Well, we get depreciation deduction, a percentage of the $6 million. So the bank doesn't get any of that. We get all of the depreciation of $6 million. That could be as much as $500,000 a year. And because we've got that much depreciation, that's just a reduction of our tax expense.
Right, so it's 500,000 extra in income, but it's actually called phantom income.
Right, so what happens is because now we have less income for tax purposes, right?
No, we don't have to pay the...
We have less income for tax purposes, so now what happens is we have to pay less taxes, okay? Because we're taxed on our net income. We're taxed on our gross income minus our business expenses. And in this case, a business expense of depreciation is like magic, because it's not money out of our pocket. We're still appreciating, we're still making money here, and cash flow from the property.
Right.
Okay, and at the same time, we're reducing our taxes. Well, anytime you can reduce an expense, now I'm an accountant, and so I love reducing expenses. And every time you reduce expenses, it's like putting money in your pocket,
So
because now you have more that you didn't spend.
Right, so this is the same number. So let's say it's 500,000. It means 500,000 in income you didn't have to spend, but it was caused by 500,000 in expenses you didn't have to spend. So you pay nothing for taxes.